accounting and cash flow. Hello, and welcome to the accounting and cash flow session. In order to run a financially successful business, you'll need to learn how to track your earnings and spending, and how to make sure you always have enough cash in your bank account to meet your obligations. This session provides a guide for good financial organization, explains both accounting and cash flow in simple terms, discusses potential tax liability issues, and introduces different financial experts who can provide assistance before you start. By the end of this session, you should be able to organize yourself and your business to keep good financial records, understand the basic financial reports used to monitor the health of your business, evaluate your business's financial reports for signs of trouble, know the difference between accounting professionals, and identify the importance of having a team of financial experts to help you. Here's what's on the agenda today. Step 1, build your knowledge. This will be your crash course in all things accounting and cash flow. Step 2, gather your accounting team. We'll introduce you to financial experts who can guide you before you even launch your business. Step 3, getting started. We're going to dive into how to keep things in check with internal controls, working smoothly with a hired bookkeeper, making sure your bank account adds up right, and keeping an eye out for potential tax liability issues. After that, we'll summarize what you've learned, and we'll share a list of top 10 do's and don'ts to help you get started. Are you ready? Let's go. Step 1, build your knowledge. In step 1, we'll cover the following. Why is financial information important to your business? What is the difference between bookkeeping and accounting? What are financial statements and why do you need them? How will you keep track of all the financial information you need? The chart of accounts. How to track what's important. Methods of accounting. And keeping business and personal money separate. Why is financial information important to your business? If you're going to be in business, you've got to know how to keep track of what you earn and what you spend. Bookkeeping software has made tracking your financial activities easier than ever. With some basic knowledge and support from a professional tax accountant, you can take care of most of your day-to-day bookkeeping yourself. Once you understand basic accounting, it also makes it a lot easier to work with a professional bookkeeper if you decide to hire one. You may have heard that basic statistic. According to the Small Business Administration, roughly 1 in 5 businesses will fail in their first year. That's right, 1 in 5. Only about half of all new businesses make it to 5 years, and only 30% of businesses will make it to year 10. 2 of the biggest reasons for business failure are lack of sales, the market doesn't know about or doesn't want the product or service offered, and cash flow, not having the cash needed to meet financial obligations when it is needed. Fortunately, both of these problems have simple solutions, and it's absolutely worth the effort to solve those challenges because the SBA also tells us that on average, self-employed people are generally significantly wealthier than regular employed workers. So, how do you keep yourself from becoming that statistic? Easy. Know your numbers and have a cash management plan. Small business financial needs are very different from that of a large corporation, but the terminology is all the same. So let's start with some definitions. What is the difference between bookkeeping and accounting? Although the words often are used interchangeably, accounting and bookkeeping are 2 different things. Bookkeeping refers to the activities involved in tracking individual financial transactions. Bookkeeping presents the business owner with clear, accurate financial statements. A professional bookkeeper can be hired by the business owner to track financial transactions for the business. Accounting, on the other hand, refers to the bigger picture, where your financial transactions and financial information are combined in standard reports or financial statements. These standard reports help you, as well as partners, lenders, advisors, and other stakeholders, understand the financial health of your business so you can make wise financial decisions. Bookkeeping is the basis of accounting. A professional accountant, also referred to in this session as a tax accountant, will gather the information from the bookkeeper, either the hired bookkeeper or the business owner, to create financial statements, prepare tax reports, and file taxes on behalf of the business. What are financial statements and why do you need them? Financial statements are the standard reports every business prepares to summarize financial information to give a complete picture of the whole business. The three most important financial statements are the balance sheet, the profit and loss statement, also known as P&L, and the statement of cash flow. The balance sheet shows how much the business is worth, including assets, everything the business owns, and what is owed to the business by others. Liabilities, everything the business owes to others, and equity, the difference between the two, assets minus liabilities. The equity is basically how much the business is worth at this time. The profit and loss statement is also called the income statement, and it shows how your business earned and spent money, and if the business is profitable or not. The cash flow statement summarizes the movement of cash and cash equivalents, like credit cards and loan payments, that come in and out of the business. The cash flow statement measures how well a company manages its cash or money, and if the company generates enough cash, money, to pay its operating expenses and debts. Cash flow is often overlooked, and businesses often take a long view of their cash situation. In other words, they estimate that they will have enough sales in the next 6 months to cover their bills, but overlook the fact that they don't have enough cash today to pay today's bills. This can cause significant turmoil when businesses, vendors, and employees are not getting paid. As a business owner, you need to feel comfortable understanding what each of these reports is telling you about your business. These reports will help you make better financial decisions and keep you from getting into a difficult financial situation. Let's talk about some examples. And you can view some sample statements for those examples on Moby's website. Landscape Services LLC is a company that provides landscaping, design, and construction to homeowners. It's a small company with 1 owner and 2 employees, and an annual revenue of about $190,000. The balance sheet for this business, Landscape Services LLC, shows the assets and liabilities of the company on a specific date. In this case, June 30th, 2025. The main assets are cash in the checking and savings accounts, accounts receivable, money owed to the company, inventory of materials and plants that have not yet been used, a truck, and equipment. The company's liabilities are accounts payable, or money owed by the company to suppliers, probably unpaid invoices, a credit card balance, money owed to the credit card company, and a long-term loan, perhaps for the truck. The difference between the assets and the liabilities is the equity in the company, basically how much the company is worth on this specific day, based on this short list of assets. The profit and loss statement for Landscape Services LLC shows revenue from design services, landscaping services, and the sale of material and plants to customers. Expenses include the cost of materials and plants, salaries and wages, and other operating expenses like utilities and fuel. Income before taxes and interest was $13,349, and after taxes and interest was $10,754. The cash flow statement for Landscape Services LLC shows how cash was collected and spent over the course of a year. It starts with cash on hand in checking and savings. At the beginning of the year, July 1st, 2024, cash coming in and going out for operations, investments, and financing are added or subtracted from the starting cash to calculate the ending cash balance on June 30th, 2025. Cash flow from operating activities is cash going in and out for operations. All activities associated with providing goods and services to the company's customers during the year. Cash receipts for the year were $187,976. To generate these sales, the company incurred expenses for materials and plants, wages and salaries, and other operating expenses, interest and taxes. All are shown in the cash flow statement. In addition to cash used for operating activities, cash was used for investing, purchasing equipment, and for financing, paying on outstanding bank loans. The cash flow statement shows that there was $12,747 at the end of the year, adding and subtracting the movement of cash in and out of the company. While the cash flow statement covers an entire year, it is common for small businesses to create monthly cash flow statements to monitor the flow of cash in and out of the company more frequently. How do you keep track of all the financial information you need? The best way to track what you earn, what you spend, what you owe, and what you own is to set up a bookkeeping system to organize every transaction in your business with receipts or other documentation for each one. As a general rule of thumb, it's a good idea to keep all receipts and bank statements for 3 years. If you are a solopreneur or sole proprietor operating your business on your own, you may choose to create a process where you place every receipt or bill in a designated spot in your home or working space. And once a week, you enter the expenses and payments on a sheet of paper or a spreadsheet. It's important to keep careful track of all the dates, amounts, reasons, and expenses, and to save all your receipts. It can be helpful to make notes on the receipts or invoices as you get them in to keep track of business purposes of the expense or payment. You may also decide it's helpful to bring your bookkeeping online with bookkeeping software like QuickBooks, Xero, Wave, or others. An advantage of bookkeeping software is that it can keep track of everything in one place by connecting your transactions with your business bank account. Most softwares even allow you to upload photos taken from your smartphone or files, PDFs, of your receipts so that you don't have to keep track of paper receipts anymore. No matter what your system, you'll need to start with a customized chart of accounts to define the accounting categories you'll use when entering your transactions. The chart of accounts. The chart of accounts is a list of accounting categories you'll use to record how you earned, spent, moved, and kept your money. Usually, your chart of accounts will have an account for every line on your balance sheet and every line on your profit and loss statement. Most bookkeeping software comes with a default chart of accounts that suggests the different types of accounts you'll need. Not every business has every type of account. The best way to start a chart of accounts is to think of where you earn your money and how you spend your money and where you keep your money that makes the most sense to match the account. For example, if you send invoices to customers, you need to have an account called accounts receivable. If you borrow money for your business, then you need an account for long-term liabilities. It's a great idea to get a professional bookkeeper to review this chart of accounts with you. Let's start by defining accounts from profit and loss statements. Then we'll take a look and define some accounts that are appropriate for a complex business. Profit and loss statement accounts. Every business has sales and expenses. So, every business will have accounts to keep track of sales revenue or income and other accounts to keep track of business expenses. Revenue and income accounts. Service revenue or income accounts. In service revenue or income accounts, you keep track of money earned by the business through sales of services. While you only need one income category to track your sales, it can also be helpful to specify the different revenue streams you have or how different activities bring in money. For instance, if you're a musician, you may wish to track your revenue from teaching music separately from your revenue from playing music. If so, you would have two different service revenue accounts. Product sales revenue or income. In product sales revenue or income accounts, you keep track of money earned by your business from selling goods or products. As with service revenue, you might want a separate revenue account for different goods. For example, if you're a grocer, you might have a different revenue account for sales of fresh vegetables versus sales of baked goods. Other income. If your business has bank accounts, it will probably earn some interest. And if you sell an asset for more than you bought it for, you will have a profit. Other income is a place to keep track of this kind of revenue, sometimes called unearned income. Operating expenses and expense accounts. Of course, you'll have expenses associated with producing the goods and services that you sell. Operating expenses are expenses associated with operating the business. Typical operating expenses include salaries expense. Expenses associated with employees who receive a salary. Usually the owner's salary is included in this account. Wage expenses. Expenses associated with employees who are not salaried and receive an hourly rate of pay. Supplies expenses. Expenses associated with supplies used during the month or year. Rent expense. Expenses associated with using a rented building or office. Utilities expense. Expense associated with electricity, heat, water, and sewer used during a month or year. Telephone expense. Expense associated with your telephone. Advertising expense. Expenses for advertisements, promotions, coupons, and other promotional items. Depreciation expense. Cost of long-term assets allocated to expense during the current year. Typically, you'll need the assistance of an accountant to determine depreciation expenses. Cost of goods sold, COGS. Cost of goods sold is a special category of accounts that reflects those expenses that directly relate to making and delivering the product to customers. Sometimes it's helpful to have accounts for each of these expenses that make up the COGS, and sometimes it's better to aggregate them all into one account. The two main components of COGS are costs of materials in producing the good and the cost of labor in producing and delivering a good. In general, a business needs to keep track of costs of goods sold only if it carries inventory. You should consult your accountant on the necessity of COGS for accounts. The accounts described above are common for many small businesses. The list does not include all possible accounts, and you should consult with a bookkeeper or accountant to make sure you're keeping track of all your revenues and expenses. Balance sheet accounts. A complete chart of accounts typically includes items from your balance sheet. The three categories of accounts on your balance sheet are assets, liabilities, and equity. Assets include all of your bank accounts where you keep your cash, accounts receivable, current assets, things that you intend to sell or use during the year like inventory, and fixed assets, things that last more than a year and depreciate like vehicles, equipment, and furniture. Liabilities include accounts payable, credit card balances, current liabilities, things you need to pay during the year like quarterly taxes, and long-term liabilities like long-term loans. Equity accounts include net income, the amount of profit or loss for the year, retained earnings, the amount of all prior year profit and loss that is retained in the business, and owner's equity, the amount of cash taken from the business by the owner or loaned to the business by the owner. The importance of these balance sheet accounts depend on the size and type of business you have. For more complex businesses, it will be important to get the assistance of an accountant to select which accounts are needed by your business and how to calculate the balances. You can see the chart of accounts for Landscaping Services LLC on Moby's website. How to track what's important. It can be overwhelming to look at a chart of accounts and know how much detail is enough and how much detail is too much. Here are 3 guidelines to help you determine if something deserves its own category. 1. Do I care? 2. Is this big enough to matter? And 3. Can I do anything about it? Do I care? If you can't think of any reason you care about what your different marketing expenses might be, then there's no reason to get into too much detail. For example, you might not care whether you're spending money on printing promotional materials or online advertising, or another marketing activity. Double check with your tax accountant to make sure they don't care either. Is it big enough to matter? Sticking with the marketing example, let's say you would like to know how much you spent on print advertising versus pay-per-click advertising online. But when you look more closely at what your spending habits are, you only print out promotional flyers once a year and spend less than $100 on printing. So is it even really that big of a difference if you stop spending on flyers? I define big enough to matter as the answer to the question, if I cut this expense dramatically, would cutting it make a difference in my profit? Can I do anything about it? There are some expenses that you can reduce by negotiating, shopping around for supplies, or being frugal. And there are others, like utilities, that you don't have a lot of influence over. So even if you were paying a lot of money for water and electricity, you probably can't choose where you get your water and power. So it wouldn't make sense to give expenses separate accounting in that situation for a chart of accounts. I'd suggest keeping it simple and just calling them both utilities. Methods of accounting. There are two main methods of tracking income and expenses: cash accounting and accrual accounting. These are two different ways of tracking and looking at how you earn and spend your money in your business. Cash basis accounting method. Cash accounting is the simpler of the two methods, reporting income when the cash, money, is received and expenses when they are paid. When you look at your reports on a cash basis, you get a good understanding of how cash is actually deposited and distributed. Accrual basis accounting. Accrual basis accounting is based on entering or reporting income when it's earned, even if it's not collected. For example, if you provide a service for which you send an invoice to be paid within 30 days, you would enter the amount you were owed on the day you provided the service. Similarly, expenses are entered or recorded when they are incurred, even if they've not yet been paid. When you look at your reports on an accrual basis, you are looking at your earning potential, what you sold, and spending obligations, which can give you a much better picture of what an average month should look like. In the US, a business only files taxes on accrual basis if they carry inventory or have more than $25 million in sales for 3 years. Most bookkeeping software allows you to look at reports both in cash and accrual, and if you don't use invoices or bills, your reports might look exactly the same. For example, if you make a sale to a customer on terms, meaning they don't have to pay for a certain amount of time, you would enter an invoice to track the sale, or income, and the account receivable. When the client pays, you would record a payment to show the receivable had been paid. Between the time that invoice is recorded and the customer pays you, your income is called accrued income. Let's say the invoice was recorded on September 30th and the client made the payment on October 15th. If you look at your profit and loss report on a cash basis, you would see the income in October and the invoice paid. If you ran profit and loss on an accrual basis, the income would show in September when the sale was made. The same is true for expenses. If a vendor provided you a service and sent you a bill, you record the amount due as an account payable in August, but actually paid the bill in September. Accrual basis would show the expense in August. On a cash basis, your income statement would show the money spent in September. There may be some special considerations in managing your money through the transition between one tax year and the next, and how best to account for income earned and expenses incurred in one calendar year, but not yet paid until the next year. A tax accountant can help provide guidance in this area. Keeping business and personal money separate. It is very important to keep your personal and business money separate. One of the first things you can do is start a new business and create a separate business bank account. It is okay to have a credit card in your name that is only used for business purposes, but you want to avoid using one credit card for both business and personal expenses. It's important to remember that in many countries, your business is a separate legal entity. One of the steps in establishing your business is to create and register a fictitious business name, or doing business as, DBA, name, even if your business name just adds one word like photography or construction to your name. It allows you to create separate finances and accounts for your personal life and your business. Your clients will make payments to your business name, and an established name will help you and your business look more professional. See the licenses and permits section for more information on this topic. If you were to get investigated or audited by an agency like the Internal Revenue Service or the IRS in the US, you are likely to have both your business and personal finances examined. Any questionable deductions would probably be denied if you don't have good separation and record keeping. Good accounting records are the key to financial success. For expenses that are partial business use and personal resources, like auto mileage and home office, it's important to understand how these deductions can be claimed. You should always pay these expenses in full from your personal account and then reimburse yourself the deduction from your business, or have a tax accountant claim the deduction when you file your tax return. Now that you have the foundation set, let's move into step 2, gathering your accounting team. Step 2, gather your accounting team. Picking the right system for tracking your income and expenses is important. What are you most likely to stick with? Pen and paper, Excel, Google spreadsheets, or an online software that talks to your bank? What will your accountant want in order to report and file taxes or provide you with the advice to keep your tax bill down? The better organized you are, the easier it will be for you and your accountant to track your finances, and the more information you'll have to run your business during the year. If you decide to choose a bookkeeping software system, you'll want to keep in mind these 4 things. Cost. You'll need to balance features with costs. Some systems have a one-time price. Others offer subscription pricing that you'll pay each month or year. 2. Growth and confidentiality. If you plan on hiring someone to help with bookkeeping, you need to be able to add them to software that you're using, and you may want to limit what they can see. 3. Integrations. Your software should be able to automatically add transactions from your bank, but you may have other software that you'd like your accounting software to communicate with as well. These might include something like your customer relationship management or CRM software, your payment processing software like Stripe, PayPal, Venmo, Zelle, and others. Be aware that a lot of specialty softwares say they're accounting software or that they integrate with QuickBooks, but they can be limited or don't fully integrate the way you expect. Make sure to get a demonstration from the software to see and understand how the integration will work. 4. Recommendations. Make the decision with the help of your accountant. If your accountant is okay with you sending reports to them instead of inviting them to your software, you'll have more choices. If they want to be able to connect directly to your software, you'll likely have to go with whatever software they're willing to work with, which is probably QuickBooks. Whatever you choose, make sure you're comfortable with using the software. You should be doing your own bookkeeping at least once a month, ideally once a week. Select your tax accountant. There are 2 types of tax accountants: an enrolled agent, EA, or a certified public accountant, CPA. In the U.S., both are registered with the government and both can file income tax returns on your behalf. A CPA has additional abilities for working with larger corporations that you likely won't need. More important than the letter after their names is to make sure they're a good fit personality-wise. It's always a good idea to check references and/or reviews. Here are 5 things to look at when choosing a tax accountant. 1. Do they understand your business and your plans for the future? 2. Are they willing to meet with you during the year and not just at deadline? 3. Are you comfortable asking questions and can you get clear explanations in plain language? 4. Do they have a similar tolerance for risk as you do? And 5. Do they come highly recommended? Your tax accountant doesn't need to be specialized in your industry. It is easy for them to come up with current regulations. It is far more important to feel like your accountant is a trusted advisor in your business. Select a payroll provider if needed. If you'll be hiring people to help you with your business, it's a good idea to hire a payroll service provider or PSP to help you pay them. A PSP will ensure that you are paying all the appropriate taxes and fees through the payroll process. As you grow your team, you may choose to hire someone specifically as a consultant or an employee, and the definitions of those requirements vary by region. Be sure you understand the difference of where you'll be operating your business to make sure you're following the law. Visit the Freelance, Independent, and Home-Based Business session and the How to Start a Business as an Independent Contractor blog for more information on this topic. When selecting a payroll service, cost is only one of the important factors. Will they help you with the other expenses associated with having employees like workers' compensation insurance, disability insurance, onboarding new employees? If you have employees in multiple states or countries, how would that affect the pricing? There are both standard payroll processing companies, PSPs, as mentioned above, and professional employer organizations, or PEO. PEOs are more expensive and usually have a minimum number of employees, but can also get you access to better and more affordable benefits, and sometimes even help with human resources functions like compliance training. Starting a banking relationship. Most small businesses think all they need from their bank is someone to hold their money until they need it. But There's so much more available when you have a relationship with your bank. When your bank really gets to know you and your business needs, they can offer customized solutions to help you grow. A good banker can help you access credit, lower fees, and connect you with a wealth management professional. It's always best to begin this relationship before you need a loan, so your bank can help you be ready if or when it makes sense for you to apply for a business loan. In the US, you'll likely need a Federal Employer Identification Number, or EIN, to open your business account. And you get that for free on the Internal Revenue IRS website. Visit the Licenses and Permits section for more information about what might be required for your business. Financial and technical assistance. Your bank may also be able to help you find funding and grant opportunities, as well as technical assistance. Or just look at some of the well-known organizations to support you in your small business growth. Small Business Administration, or SBA. Service Corps of Retired Executives, also known as SCORE, which is a nonprofit organization whose goal is to help small businesses become more successful. SCORE offers workshops and seminars on various business topics and may give you the opportunity to talk to someone who has business experience. Local community organizations and business development centers, or trade organizations. Step 3, getting started. Congratulations on getting this far. You've got the knowledge and the team, and in step 3, it's time to get started with your business. As you begin your work selling and servicing clients, here are some best practices to keep in mind. Internal controls. Internal controls are policies, processes, and procedures you set up for your business to avoid mistakes, fraud, and wasted resources, and to ensure the accuracy of the financial reports produced. It isn't enough to earn a lot of money if you aren't collecting it or if you don't know how it is being spent and if it is being spent properly. No one person, even the owner, should have the control over all parts of the financial transaction. There should always be a second set of eyes to help review transactions for accuracy. How can you make sure mistakes aren't being made? Here are some of the things to consider when creating internal controls. 1. Dividing up responsibilities. The person who deposits the money should not be in charge of recording the deposits, or if they are, it should be double-checked by your accountant or bookkeeper through the reconciliation process, the process where you compare your reports with your bank account. 2. Regularly review your bank and credit card statements to see if there are transactions you can't explain. 3. Restrict access to cash and inventory to make sure things don't go missing. 4. Decide on who has authority to order supplies, receive goods, and pay bills in your organization, and who will double-check their work. Dishonesty is far too frequent, and honest mistakes are even more frequent. The best way to make sure things don't go wrong is to have safeguards in place as soon as possible. By setting up controls and systems now, it will make it easier to assign responsibilities with less stress later on. Working with a hired bookkeeper. Most business owners do their own bookkeeping to save money when they first start their business. Since you are the one earning and spending the money, this is a great idea, as long as you do know what you're doing or you get some training on how to do it from the start. At some point, however, you are going to get too busy and your time will be better spent on getting new customers and keeping them happy. Bookkeeping is one of the easiest things to delegate to a professional if you know how to read your reports. It is important to ask your bookkeeper what they need from you in order to correctly record transactions and how many days they need to process or reconcile the previous month and send you reports. While a license is required to be an accountant, there is no formal professional requirement to be a bookkeeper. So be sure to check references and reviews before hiring someone, and always review all the work that is done to make sure it makes sense to you and your accountant. Bank account reconciliation. This process is important because it ensures that you can identify any unusual transactions caused by fraud or accounting errors. Reconciling is a process that you can do on paper or in your accounting software to compare your own financial transactions to the monthly statement provided by your bank or credit card company. Reconciling is important because it ensures that you can explain any difference between what your software has as the book balance to what your bank has as the bank balance as of a certain date. It's important to do this monthly and make sure you are always up to date to catch any errors. Reconciliation will also help you avoid making payments that exceed your available money, known as bouncing payments, because you forget about the check you wrote. When you can explain any difference between the bank balance and your book balance, then you are reconciled. Do be aware that if a transaction still hasn't cleared after 30 days, there may be a problem, and you may have to reissue the payment or verify it wasn't entered twice into your software. You are checking in order to make sure you have recorded all transactions that have cleared your bank and to make sure there aren't any outstanding transactions like checks that haven't been cashed. Tax liability issues. Your business tax liability depends on the country, state, county, and city in which you operate. Let's discuss the taxes that are common in a business operating in the U.S. Income tax, payroll tax, and sales tax. There are several kinds of taxes you'll be responsible for paying. Some of the taxes, like sales tax, you collect from others and pay to the government. Others, like your income tax, will be based on your business activity. We refer to these as liabilities since it's something you owe but haven't paid yet. Your tax accountant can help you stay in compliance, understand your financial responsibilities for these, and make appropriate payments within any required schedules, with all varied taxes and their due dates. Income tax. Income tax is the money you owe based on the net income, that's income minus expenses, of the business. You may also owe unincorporated business tax on your earnings, the amount that would have been paid into Social Security had you been paid through payroll. Be sure to talk to your tax accountant about how much is set aside to save for taxes. 15% of income less expenses is a good place to start. If you owe more than $1,000 in total income tax for the year, you'll likely be required to pay quarterly estimated income tax payments. Your accountant can help you determine if you need to pay these quarterly taxes and their due dates. Also, you can request the paperwork from the IRS to submit these on your own. Payroll tax. If you have employees, you'll need to set up and collect payroll taxes. This is another reason it is a good idea to hire a PSP. If you haven't already gotten an employer identification number, EIN, to open your business bank account, you'll need one now. You can apply online for free on the website for the Internal Revenue Services, or IRS. You likely will also need state identification number. Your PSP and your tax accountant can help you apply for that number. Disability and workers' compensation are additional costs to running payroll. These aren't taxes, but insurance expenses, so your PSP may not take care of paying these for you. Be sure that you work with someone who understands all the payroll requirements for your location. Sales tax. You should register for a sales tax license before you begin to sell and collect sales tax from customers. You can usually register online with your state's Department of Revenue to get your permit. See Licenses and Permits section for more information. Each state and county makes its own rules when it comes to sales tax. If you do business in multiple states, don't assume the rules for collecting and filing are the same. The frequency and due dates might be different as well. Generally speaking, you only need to collect and file sales tax in states where you have nexus. Nexus is just a fancy way of saying you have business activity in a state. Things that could give you nexus include being an e-commerce business, having a physical location like a warehouse or storefront, employees, or affiliates. Sales tax can be really confusing, so be sure to get the support you need to stay on track and out of trouble. A note on VAT. The United States, unlike many other countries, does not have a value-added tax, or VAT. VAT works like a sales tax in that it's an additional amount added to the cost of products and/or services based on a percentage. One difference between a sales tax and a VAT is that a VAT is usually determined by the government of a whole country rather than local government like sales tax in the U.S. Some VAT taxes have both a federal and provincial component. For example, if a product or service costs $100 and there's a 5% VAT, then the customer would pay $105. The merchant would keep $100 and save and remit the $5 to the government. In some countries, the merchant or business owner may deduct the amount of VAT paid against the amount of VAT collected before remitting to the government. It's important to know the regulations for your location and have a good system to track what you have collected and paid so you're remitting the correct amount to the government. Summary. In this session, you learned how to organize yourself and your business to keep good financial records by using a method that works for you, whether it's pencil and paper, spreadsheets, or an integrated accounting software to automate and streamline your transactions. You learned about 3 standard financial reports: the balance sheet, profit and loss statement, and the statement of cash flow, how to organize, read, and understand them to gauge the health of your business. If you've decided on and started using a software of your choice, hopefully you've also customized the chart of accounts to your liking. You've learned some of the different accounting professionals who can help you along the way and answer questions, give you guidance to make your systems and make sure they're set up correctly and maintained. Now, all there's left to do is to go do it. Whether you plan to do your own bookkeeping or hire someone, remember, this is your business and you should always check the advice and direction given by others to make sure it aligns with your plans for the future. The Moby website provides an accounting and cash flow action list to help you complete the action items covered in this session. Top 10 do's and don'ts. Top 10 do's. 1. Separate out your business spending from your personal spending right away. 2. Review and reconcile your bank statements each month to make sure your bookkeeping is accurate. 3. Keep all your receipts and bank statements for at least 3 years. 4. Take responsibility for knowing tax deadlines and making sure you're making payments on time. 5. Make sure your accounting team is able to make time to talk to you and answer all of your questions. 6. Be intentional about spending money. Only spend when the expense will almost certainly bring you in new money in the next 30 to 90 days. 7. Set aside a percentage of your earnings into a savings account to build up an emergency and growth fund with at least 3 months of operating expenses, starting with just 1% and try to increase that to 10%. 8. Pay yourself. You should be taking home approximately 25% of your business income. 9. Get your business team, accountant, bookkeeper, and peer mentors together to meet regularly for support and accountability. And 10. Set achievable goals for yourself. And remember, you define what success looks like for you. Top 10 don'ts. 1. Don't get discouraged if you don't do it perfectly. Learning new things takes time. 2. Don't ignore your intuition. If something doesn't feel right, get more information. 3. Don't allow others to take advantage of you, and don't mistreat those who don't support you. 4. Don't assume because something worked for someone else that it will automatically work for you. 5. Don't try to do it all yourself. Stay in your zone of genius and ask others to help you with the rest. 6. Don't avoid responsibility. Your business belongs to you, and no one else will take as good a care of it as you. Delegate only when you can evaluate and manage others. 7. Don't wing it. Even Yogi Bear said, without a plan, even the most brilliant business can get lost. Make sure you know where you want to go so that you can make sure that you're headed in the right direction. 8. Don't spend the money you have saved for taxes. This isn't your money. It belongs to the government. 9. Don't wait until last minute to do your bookkeeping or file your taxes. And 10. Don't underestimate the amount of time and money you'll need to start your business. Make sure you have adequate resources and a backup plan. Congratulations! You have completed this session. If you happen to be writing your business plan while taking this course, just take a moment to now include any of this new information related to your business plan from this session. Moby's free business plan and other worksheets, checklists, and templates are also available to you for download. Good luck! You're just getting started. This session can be taken on its own or as a part of a full course to earn a certificate of completion and/or digital badge from Moby and Santa Clara University. If you're taking this as a part of a course or want to enroll, be sure to log on and take the corresponding quiz or final exam as appropriate. You can access more topics, courses, and helpful information for your business at www.scu.edu/MOBI.